we have with us Siddharth Bothra, Fund Manager, Equity Ambit Asset Management. Siddharth, hi, Ankur this side. My first question to you, when do you think this consolidation phase will end?
Hi, Ankur. Thanks for having me on the show. Our view on the market says that if you look at the next 2 years, the earnings growth looks a bit tepid, more in the early double digits, and valuations across the market, whether it be large cap, mid, or small, are above their long-term averages. So the return outlook for the next 2, 3 years looks muted, and also the fact that it's coming out of the markets coming on the back of a couple of very strong years. So we think the market going forward is going to be very stock specific, and that's one advantage that India has. You have good opportunities across various sectors. So going on from here, I think while we had a very easy time over the last 3 4 years where money making was relatively easy in the stock market, and market was very broad based. Our house view is that as we move ahead over the next 2 3 years, market is going to move from a very broad based market to more concentrated. The move will be more towards quality, more towards stock specific. So it's going to be a difficult market, and you need to be very stock specific to kind of earn more than the kind of outlook we have on the returns given the muted earnings growth and valuations being high.
All right. Hi, Siddharth Kavita, this side. And well, let's also, understand your sector takes and your sector approach. Now, looking at the churn that's going on sectorially, which are the laggards according to you, and which are the one which you would bank on for maybe 2 to 3 quarters now? I know you'll be talking about long term as far as your strategy is concerned, but then there has to be some sectors where you are betting really high on and some you think that are out of flavor and trend.
Right. So, Kavita, as I mentioned, while the broader outlook remains muted, not many sector specific stands out, but some of the sectors where we would kind of look forward to. One is the consumption sector. It's not done that well over the last 1 2 years. Now there seems to be many kind of green shoots which suggest that this sector could come back, whether it be the moves from the government side on the tax side, or whether it be the upcoming pay commission opportunity. And all these things suggest that the consumption theme could be something to look at with a 1 to 2 year perspective. The other segment where we would be positive on would be the industrials one. We believe while the private capex could still be a couple of quarters away, but on the industrial segment, I think if you go stock specific, we think there are a lot of opportunities. Many companies seem to be benefiting in a big way from the advent of AI, by the fact that increasing use of software and technology is getting embedded in most of the industries. So companies which have technological advantage, which are dominant in those particular segments, we could see opportunities there. So consumption, industrials, and the broader BFSI, we think still looks fairly attractive. So these are the 2 3 sectors, other than say, the other one could be pharma itself, where again we like some of the domestics plays itself. So these are the 3 4 sectors we would be focusing on.
Siddharth, I want your view on real estate sector. If you talk about today, it is the top sectoral gainer today. How do you see this sector particularly? Because it is again, once again, linked to economy, how things are moving up. What is your view?
So real estate is a rate sensitive sector, and stands to benefit from the recent rate cuts, and also the loosening liquidity environment that we are seeing. So in that sense, I think real estate is not a sector where you can take a very long-term view, but within that currently, I would believe that it looks attractive. And also certain things have changed in real estate sectors over the last few years. Increasingly, consolidations happened. Some of the companies, have now become more broad-based. Like earlier, it was more about the value was coming more from future growth. Now, you have some good opportunities where valuations could be justified by cash flows. So this is a sector where one needs to be still very stock specific, and the view here has to be more short term to medium term, I would still believe, because this is not still a sector where I would take a very long term call. But this again is a sector where one needs to be very stock specific, and within that we think, there are some of the stocks which do stand out, and even we have looked at it several times while we don't own any of them.
While we are talking about, we are talking on equities, and you might not want to explain much or go much towards commodities, but I still want to know your view about gold and silver. Looking at the prices and the rally that they have shown, it's very important. See, when you talk about a portfolio, you anyways cannot miss the diversification part, and for that reason you at least need to have 10 to 15% exposure in gold and silver. But then how are you placed, and is this the time for one to go heavy maybe in gold or silver? There are few offerings in the market which one can really opt for, which automatically provide you with all the diversification. But overall on a portfolio level, because you are an industry veteran, and you've always been guiding your clients and our viewers also, diversification is a very important role. So what will be your take as far as being diversified in gold, silver, or the commodity aspect in the current market change or the scenario that we are into?
It's an interesting question. So when you include the entire commodity with gold and silver, I would look slightly separately, because overall outlook on the commodity, if you look most of the commodities, including crude and all, they do look they are weak in a way. But yeah, gold has been complete contrast. Like right from beginning of the career, we had always thought of gold as being an hedge. So whenever markets looked very upbeat, or when markets were weak, you would look for gold or silver as a contrary bet. But in the last few years, it's like almost turn out to be the other way. Like everything's going up, and in fact, if you look at gold on a 20-25 year basis, it's kind of even beaten some of the best markets. So I'm a bit baffled here, because the inherent thinking on gold, other than the fact that now more and more central banks are looking to increase their hedge and have more gold, which in a way shows lesser confidence in the global financial sector. That's a very broad theme. But other than that, the view on gold has always been that this is a asset class which does not, kind of actually produce cash flows, and hence, for investor, other than some kind of a diversification should be avoided. So, other than that broad view that central banks are now increasingly looking to add more and more gold, I would believe that you would probably make better returns in equity from here on, rather than being in gold or even silver.
Thanks, Siddharth, for sharing the strategy of portfolio management in detail. But with this, it's time to take a very